This video will describe the contents of the Cash Driver Report, one of 6 reports provided by the Fiscal CheckUp software. The focus of this report is to evaluate the 3 balance sheet accounts that affect cash flow. The first page analyzes accounts receivable. The headline on this page will contain one of 2 statements, depending on whether the business is operating above or below the industry average for accounts receivable days. If the business is operating better than the industry average, it will state the amount of cash added because of this superior performance. If operating below the industry average, it will say how much extra cash could have been generated if receivables were improved to industry levels. The narrative discusses the range of AR days for the company and the industry. One of the graphs on the bottom of the page displays this information graphically. Specific ratios and other relevant industry and company data related to accounts receivable are discussed on this page. There's also a graph showing the AR as a percentage of sales. Ideally, as sales change, this number should remain relatively constant. If the percentage is increasing over time, it suggests that the company may be extending better payment terms to the incremental sales, or that the incremental sales are being made to customers who pay their bills slower. The narrative contains several suggestions on establishing credit policies and procedures, as well as concepts to improve AR management. The second page analyzes inventory. The headline on this page will contain one of 2 statements, depending on whether the business is operating above or below the industry average for inventory days. If the business is operating better than the industry average, it will simply state that the inventory has been managed better than the industry. If operating below the industry average, it will say how much extra cash could be generated if inventory were improved to industry levels. This page contains a discussion of inventory and how the company compares to their industry, as seen in the inventory days graph on the bottom of the page. The discussion may include, if applicable, a dollar amount that could be generated if the company had been able to achieve their best inventory days, and that value is applied to the last fiscal year for improved cash flow. There's also a graph showing the inventory as a percentage of sales. Ideally, as sales change, this number should remain relatively constant or even go down. If the percentage is increasing over time, an analysis should be performed to determine the reasons behind the increase. The narrative contains several discussions on managing inventory. Depending on the company, an improved inventory management system can be a wise investment. If this is an area that needs improvement, the business owner should consider engaging their CPA or business advisor to determine optimal solutions. The third page analyzes accounts payable. The headline of this page will contain one of 2 statements, depending on whether the business is operating above or below the industry average for accounts payable days. If the business is holding on to their cash and paying their bills later than the industry average, the headline will say how much cash has been generated by this practice. If the business is paying their bills faster than the industry average, the headline will say how much extra cash could be generated if bills were paid similar to industry standards. The narrative discusses the range of AP days for the company and their industry. One of the graphs on the bottom of the page displays this information graphically. Also on this page is a chart showing AP as a percentage of cost of goods sold. Generally, this chart will track the payable days chart, but any significant changes should be investigated. The narrative contains several suggestions on establishing payment policies and procedures, as well as concepts to improve accounts payable management. If accounts payable shows the largest opportunity to improve cash flow, realize that means the company's paying their bills quickly. This may be a good practice, especially if the company is taking advantage of discounted terms for quick payment. Should the company need to generate more working capital, they would simply need to pay their bills based on the terms of each invoice. Page 4 ties all of the working capital accounts together with the cash conversion cycle. The cash conversion cycle measures the overall efficiency of the company in managing its cash. The calculation simply adds receivable and inventory days and then subtracts payable days. The cash conversion cycle, measured in days, is the amount of time cash is tied up from the moment a supplier invoice is paid until the company is paid by its customers. This chart also shows the amount of cash generated or consumed by the management of each of these accounts. The company performance is compared to the industry and presented both narratively as well as graphically. The concept of working capital turnover is also explained in the narrative as well as graphically. The higher the working capital turnover, the more money the company has to manage and grow the business. For each report, there is the ability for the user or business advisor to add comments. If any were entered, they're listed on this final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.